How do you know if a stock is priced too high or too low? What we're going to do today is value a stock based on their financial information. And you're going to have to watch the whole video because you're going to see pop-ups like this on the top of the screen, which is going to give you more information about this company, about the market as a whole, and about the ratios that we look at. So what we're going to do is do a discounted cash flow model. And this is what all equity analysts and large investors do when they want to value a company. And I'm going to go through the entire process with you to show you where I pull the financial information and where I put into the spreadsheet and how I calculate it. And the company we're going to look at today is LVMH. That's Moët Hennessy Louis Vuitton. And this is a French multinational corporation specializing in luxury goods located in Paris. And it was formed in 1987 between a merger of Louis Vuitton and Moët. And this company sells fashion clothing, wines, perfumes, watches, jewelry, and a lot more. So let's get started with the model. So first we need the market cap, which is the value of the company according to the stock market. That's 190.94 billion euros, because everything in this video is about euros, because this stock trades on the Paris Stock Exchange. And the stock price is 379.15. Let's get the free cash flows. And this is the cash that's left over after operating your business and paying for capital expenditures. So you want to invest in a company with positive free cash flow. And if they don't have positive free cash flow, that is a red flag. Although it could be a sign of a company that's in a growth stage and investing a lot in their business. So make sure that's the case. Net income is the profit and loss. And last, we're going to pull the revenue, which is the sales. And now the model is able to calculate the future free cash flows, but we need the discount rate. So we have to look at the company's capital structure to figure out the discount rate to apply to those cash flows. So they pay $446 million on their debt. And let's go to the balance sheet and see how much debt they have. So current debt is $7.6 billion, and long-term debt is $5 billion. So they have more current debt than long-term debt. So that means they have $7 billion of debt that's due within 12 months. So they're likely going to have to get new debt to pay the old debt. But hopefully interest rates stay low for this company, because if they go up, that could really raise their interest expense. Since debt is tax deductible, let's get their effective tax rate. So we need the interest income before tax of $10.7 billion. Then the income tax of $2.9 billion. So they pay 27% in taxes. So the cost of debt after the tax deduction is 2.5%. Now let's get the beta. That's the volatility of the stock. And they have a low beta, 0.89, so the stock is not too volatile. So we also need their equity, because we need to find out the weight of the debt and equity. So let's go back to the balance sheet and get the stockholders' equity, which is $37 billion. So we can see they have 26% debt in the capital structure. And the cost of debt is 2.55%. The cost of equity is 9%. So when you blend those together, you get a weighted average cost of capital of 7.45%. And that's what we're going to discount the future cash flows by. So we estimated the future free cash flows of the company for 4 years. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today. And we get a value of the company of 140 billion euros. And when we divide that by 504 million shares, we get a stock price of 278 euros. It's trading at 379 euros, so it's trading at a 36% premium. So it's a sell according to the model. Let's see where it was trading at the past few years. So it looks like it was trading around 270 maybe 6 to 12 months ago, and it's been trading at a premium ever since. So if an investor thinks the stock is worth $500-600, they're definitely going to buy it for $379 because they think it's a great value. And then the more people that buy the stock, the higher the price goes. But if there's mostly investors who think the stock is only worth $250-300, they're not going to buy the stock, or they're going to sell the stock they have. And that will force the price to go down further and further. So stock price is based on supply and demand in the market until equilibrium is met. And people look at different things when they try to value a company. They look at the fundamentals, which is what we did. Then they look at the technical factors like the competition, inflation, those types of things. And market sentiment, which is the hardest to value. That's how people feel about the company or feel about the industry or even feel about the market as a whole entity. So let's look at their ratios to see if we get more information. So let's get their current assets, which is $26 billion. Their current liabilities, which is $22 billion. Their operating income, which is their earnings before interest and taxes, and that's on the income statement. That's $11 billion. And their PE ratio, which is the stock price over earnings per share, is 26.6. So I like to see under 15 before I invest in a company. They also have a fairly high price to sales ratio. I like to see under 2.2. That's a stock price over the sales per share. They have a good current ratio. I like to see between 1.2 and 2. This just implies how much cash you have on hand to pay your short-term debts. So they're in good shape here. A nice ROE, I like to see 20% or above. They're at 20%, so they're providing a good return to their shareholders. Interest coverage ratio is how many times they can cover their interest payments on their debt. The interest payments for them is $446 million. So they can cover it 25 times, which is great. So there's no concern about them needing to take on more debt or ever going into default anytime soon. So let's look at their default risk. It's only 1%, so that's really low. So overall, the company looks pretty strong. But even though a company looks good on paper, you have to compare it to what they're trading at. If they were trading at $200 a share, it would be a great value. But if they're trading at almost $400 a share, so therefore I would not buy the stock. But that's for you to decide. And thanks for watching the video.